Okay, Saria owned a business selling lady clothes. She maintained a system of double entry bookkeeping. The following occurred during the September 2022. Purchase of motor vehicle on credit for Sharper Motor. Ruhi, a credit customer, was declared bankrupt, owing 1,002. The debt is to be written off. That means we need to write off the debt, means irrecoverable debt in the question will come up. Prepare journal entry to record the above. Narrative are not required. Since that they say narrative are not required, means don't need to write the reason why you put through the journal. So we do the A section first, the journal. Okay. The first one, the number one is purchase of motor vehicle. Motor vehicle is a non-current asset and on credit from Sharper Motor. So the double entry will be debit motor vehicle and credit Sharper Motor. And the amount 6,350. Okay. The next entry, Ruhi, a credit customer, was declared bankrupt, owing Saria 1,200. The debt is to be written off. That means irrecoverable debt. Debit irrecoverable debt, and credit the person name, customer name, which is the Ruhi, which is 1,002. Since that they say narrative is not required, then we don't need to write down the reason. So that's for the section A. Now we go to the section B. Salia is preparing her financial statement for the year ended 30th September 2020. She provides the following information for the feature and fitting provision for depreciation. This is beginning of the year. During the year, the transaction sold feature and receive a check. The feature has been purchased on the 1st February 2018 for the 1500. Purchase new feature paying by check. Saria policy is to provide the depreciation on the feature and fitting at 10% using reducing balance method. So before we do it, since that they say depreciation method is reducing balance method. So start to think about the formula first. What is the formula? Cost minus provision for depreciation and then times the percentage. This is a general formula that we get. Or another is called net book value, because cost minus provision for depreciation is the net book value times the percentage in the question. So how are we going to know that? Because this question, you see, they got sold, got purchases. A full year depreciation is just in the year of purchase, but not in the year of disposal. So the question is that the feature has been purchased and they didn't tell us how many years that we got to calculate. So we had to calculate it first in order to find what is the total accumulated depreciation to be reversed from the provision to the disposal account. The disposal asset, disposal asset. We purchase date is on the 1st February 2018. And the cost that we purchase is 1,500. And when this financial year, 2019 October beginning year, so at the first year depreciation to calculate, okay? We calculate the first year depreciation for this asset first. First year depreciation, it starts from the 30th September 2018. This is the first year for this disposal asset. Okay, and the amount is 1,005 times how many percent? 10%. So we get 150. And second year depreciation is 30th September 2019. So the formula will be taking 1,005 minus 150, and then we times the 10%. So we get, let me count first. Okay, 1,500 minus 150 times 0.1. So 135. 135. Okay, this is the second year. And this second year, come to this financial year, this amount, these two accumulated amount. Total is 150 plus 135. So this total amount, we're going to become the opening balance, which is on the 1st October 2019. The provision amount, provision for depreciation amount, accumulated depreciation. It will be the 285. So this is for disposal asset. And the amount given in here, later on, we need to reverse out if the question asks to prepare the provision account. Okay, so basically this is how we calculate the depreciation. Okay, for the new asset purchase, basically is just straight away take 3,005 times this one. Okay, now we go to see got any question they ask about. Okay, they ask to prepare the feature and fitting based on the information given in the question. So let's open the T account first. Feature and fitting account. Date, detail. Okay, see what else the accountant asked to prepare. Okay, they asked to prepare provision for depreciation and disposal. Okay, we one shot we ready it so that easier later. Provision for depreciation of feature and fitting, and then another one is a disposal account. Disposal of, okay, because this I want to move out easier for me to see. Yeah. Let me put it to share. Okay. The first entry we put is this one, 2019, October 1st, balance brought down. This is a cost amount 28,600. Another entry which is the accumulated depreciation 6185. So cost is in the debit side. Provision for depreciation is in the credit side. And the amount is 6185. The second information, January 31st, sold, feature, and receive a check. So sold means that the feature as cost will have to reverse it out. 2020, January 31st. And this one go to the disposal account. All the asset related to the disposal go to disposal account. Same thing, this one credit, disposal account will be debit. So we debit disposal. Okay, debit disposal. Feature and fitting. The amount is 1,500. Okay, and then just now we already calculated the total depreciation that disposal asset accumulated is 285. So we reverse from the provision account. So debit provision account, which is 285, and credit disposal account 285. So the double entry. Okay. Provision for depreciation. Okay, this is the amount. And now they say that sold, feature, and receive a check. They mean this 1150 debit bank must be debit bank because they say check. 115 debit bank, credit disposal. So here must be bank and amount 1150. So this is a double entry that we get. The next is that purchase new feature paying by check. The moment paying by check means that your bank account must be credit, and then feature and fitting account is debit. So in here we put 2020 March 31st bank 3,500. Okay. After that, no more other information related already. So basically we can close. And the question saying that close the account by balancing or by making appropriate year-end transfer. The year-end appropriate year-end transfer, they are talking about disposal account. You have to close it and transfer to the income statement. Okay, we do the cost first. So the year-end is September 30th. So balance carry down. Okay. Take the debit total minus the credit. So we get this one 30,000. Bring it to here, become October 1st balance brought down. So this is a double entry for the feature and fitting for the cost. For the depreciation, don't forget we have to calculate the year during the year September 30th. How much the income statement that we have to put in as a depreciation. I do it in beside here. Our cost beginning year. Okay, let's put in 1st October 19. The cost is 28,600. 28,600. This is the cost. Okay, and the provision for depreciation. In the beginning year is this amount. So the net book value, this is the net book value for the on net book value beginning of the year, which is 1st October. And during the year means that 30th September 20, we have a disposal. We need to take the cost. Our cost is 1,500. we already calculated the accumulated depreciation, which is 285. Take this one minus 1500 minus 285. So this is a disposal of the asset. We have to minus out first to get this amount. This is an existing old asset. This is an existing old asset in. And during the year, we have the purchase. The purchase, the new asset purchase, new purchases. The new purchases amount is 3,005. So we add these two together. So this amount, we need to calculate the depreciation. So the depreciation charge for the year, we're taking the 10% of it. So take this amount times 10%. So we, so this one times 10%. So we get 2,470. So we put into here. This amount is for this calculation to get the income statement amount. After that, balance carried down, balance brought down. So balance carried down. The subtotal, as usual, debit credit must be the same. Okay, take the credit minus the debit and bring it down to here. Become, okay, this one, how come? Okay. Balance what down? This amount, 8,370. So disposal account don't have balance carried down, balance brought down. The differences must transfer to the income statement as a gain or as a loss, depending which side is small. For example, here, this one credits, debit side is small. So in this case, my amount to balance off will be this one. Okay. So in this case, I had to take debit minus credit. So I get 65. This 65 is my losses actually. Income statement, transfer to the income statement. This is actually is a loss on this disposal. No carry, no brought down. So that is how we prepare the fixed as non-current asset and the disposal of the non-current asset. Okay, now let's move on now. Okay, I try to be a bit slow. Saria considering forming a partnership with her friend Amy, who run the similar business. So the key thing that you have to be careful, what is the key thing in here? They say run the similar business. Actually, they are competitor. Amy and Saria is actually is competitor, but now they want to form partnership. Advise Saria whether or not she should form a partnership with Amy. Justify your answer with 2 advantage and 2 disadvantage. So advice means that give pro and con. They also emphasizing disadvantage, advantage. So what is the advantage forming the advantages of forming partnership? Number 1, okay, we have more capital. Because why? More capital, partner can contribute more compare to sole trader, because Saria now is a sole trader, 1 person. Other than that, if they are the same business, I mean they have the same knowledge, then it's also reduced. When they combine, reduce the competition, because they are the same business. They both run the same or similar business. When they combine also, it will share the knowledge, and skill. So what is the benefit to grow the business? Other than that, when you have a partner, so you have the workload can be shared. Workload share among both. So it's good thing that Sadia have more time to rest. That's a good thing about when you form a partnership. But disadvantages when we form a partnership, we are not so free compared to the sole trader. We can do what we want. So less freedom. So Saria has to get agreement from Amy to run from Amy how to run the business. Second is that if your partner do something not without your knowledge, you are bound to liable to it. Okay. Bear the responsibility of another partner for legal action related to business. So even though you are not agree, you still have to bear for it. Next is a not good is that the important is a profit has to be shared among partner. So your money get into pocket maybe have lesser really. So come back to this one. Advice means you have to give a final whether you agree or not agree. So what is your recommendation? If you choose to agree, then you try to talk something about it. If you choose disagree, then you talk about this one. For me, I feel I agree because since they are the similar business, then it's to avoid the competition. Okay, it's good that they join it, then they can buy more and maybe they can get more discount. So for me, I agree they join it. So I would advise Saria to form a partnership with Annie because they are in similar business. This will reduce the competition in the market. At the same time, they can buy more goods to get better trade discount from supplier. They can share the workload to grow the business. So because I'm not, I didn't check how many marks they given yet. Give me a minute. Okay, the question is only 5 marks. So basically, they want 2 advantage. You give 2 advantage, you get mark already. 2 advantage, you get mark. So basically, the recommendation only give you 1 mark. So you don't need to talk too long for the recommendation. It's more than enough already, this one. Okay,